So, part of the American dream is owning your own home, and most people can qualify to get one. But I've got some tips about how you do that because we're with our mortgage expert, Union Home Mortgages, Mick Szoka. Great to have you with us today.
Good morning. Great to be here.
So, Mick, in the past months, we've been talking about the different aspects of a mortgage, the things that you need to be aware of, how you prepare, and that kind of thing. So, let's just sum those up. What are those four main points?
Yeah, so in the previous segments, we talked about credit, income, collateral, and assets, which are the four pillars to a mortgage. You know, starting at the top with credit. Credit's very important. Credit is a indication of how you, as an individual, have made your payments, your habits of making those payments on a monthly basis, and the better the credit score that you have, obviously, the more opportunity you have in borrowing for a mortgage.
Because I think it goes to, I don't know, above 800 points or something, but how do you manage to get a high credit score? What brings that down?
Yeah, so the biggest thing with credit scores is making your payments on the due date. You know, get them there on time. Obviously, the other part is not maxing out the obligations that you have. Don't max out the credit cards, the loans, so forth, because, you know, all those payments are going to be counted in towards the maximum amount of monthly payments that you can have in
because even if you're making all your bills on time, you're paying everything, all your debts that you have every month and on time and all that, it still matters if you have too many extensions out there, like
exactly, and so that's where it kind of rolls into income. Income really is the ability to repay your financial obligations. So not only are we going to look at the mortgage payment that you have, we're going to look at the other debts that you have, because having a new mortgage, increasing a monthly obligation to an individual may cause them problems in making those payments.
Kind of stresses out that income.
Absolutely.
Because I mean, you know, you think individually they might not be bad. Maybe credit card payments, and you know, maybe you have a new car, you know, things like that. What other kinds of things? Oh, college loans.
Yeah. Yeah, so think about it, you know, the things we're going to consider are borrowed monies.
Ah, okay.
So utilities, those types of things don't count. It's anything that you've borrowed. Car loans, student loans, credit cards, personal loans, those types of things.
Does your equity loan, well, you don't have a house yet, that wouldn't fit in unless you have like a secured loan.
Yeah, if you're doing a refinance, that home equity loan or any other type of secured loan also counts, yes.
Oh, okay. How much you still owe on that.
Exactly.
Okay, obviously, because, you know, when you're getting a mortgage, they're giving you their money.
Yes.
And so they want to make sure they're going to get their money back.
It's very important to determine the ability to repay. And so that's why we look at income. It's important, you know, typically great guideline is to be on a job for 2 years. It doesn't have to necessarily be the same job, it needs to be the same line of work. There are a couple of variances to that. If you're coming out of college and working with in the field of your degree, can roll right into that. Or coming out of the military and working in some field that you worked in the military, we can roll into that.
Oh, okay.
But typically you want to look at 2 years.
Yeah, because I know I was able to go from radio to TV because it's still in the same field.
Exactly.
They figure you've got the experience to be able to handle whatever that new job description is.
Yeah, and the idea is that more than likely you took the different job because you were improving your own position.
Gotcha.
Right, so you went
moving
from,
up the ladder
radio
in the world
to TV, you know, maybe the income aspect was improved.
Okay, now what about assets? Because I know that kind of what you already have has some impact on whether you get a mortgage.
Yeah, so when we talk about assets, we're talking about actually liquid for the most part. Cash that you may have in a savings checking account, some other liquid type of account, some 401k funds can count towards this, because as we've discussed, many programs require a down payment, but there are programs that do not require a down payment. But even the ones that don't require a down payment, we're going to want to see that you have some assets left. So when the first payments and the payments start, there's liquidity there, right? Because life happens. We all know that. So we don't want a person to start into the home ownership financial obligation and not have any reserves.
So that's like a savings, or as you said. So what? My grand piano and a paid-off car doesn't really count that much?
No, because they're not liquid.
I guess you could sell them, but it's going to take you a little time maybe to get your money out of
Now,
it. Okay.
you can sell those personal items to generate money to put forth towards a purchase of a home.
Initially.
Initially, right. So say someone has a grand piano, like you mentioned, needs money to complete the transaction. If they sell the grand piano and we have a bill of sale, it's viable funds.
Wow, nice. Okay, and then finally, collateral.
Yeah.
Now, this is kind of a cool
Fancy word.
Like collateral damage. There's a movie,
Yeah.
you know, Tom Cruise or
right.
anyway.
Different
not
definition,
collateral damage. Okay.
Different definition of collateral. Fancy term. What it means is the home that you're financing.
Oh,
so,
okay.
obviously, you know, a mortgage company such as ours or any other mortgage company is going to lend at or below what the value of that home is, right? So, obviously, an appraisal needs to be performed. Now, there are ways of not having to have an appraisal based on how much money that you're putting down, what the loan to value is. That loan to value basically means if you're buying a $300,000 house, but you need to only borrow $150,000, your loan to value is 50%, right?
Oh, okay.
So basically, what we're talking about collateral is the house itself.
It's sort of security. So,
exactly.
I mean, if something happens, you default on the loan, aren't able to make, then that is your collateral. That is your security.
Right.
They take the house away. Oh.
Right.
Let's just
We
say
don't
on
want
a
to do
car
that.
or something
Yeah,
like
we
that.
don't want to do that.
But I know that banks and mortgage companies like Union Home Mortgage are very careful to make sure that all these things are in line so that a person is really going to be comfortable making those loans and keeping that house. And,
Exactly.
you know,
exactly. And as I think we started with one of the first segments, is the plan. Anything that happens, if you really think about it, anything that happens successfully in life starts with a plan of some sort, right? Whether it be a football game, whether it be building a house, whatever it is.
Make your plan
have a
and do
plan.
it.
And I love to help people make a plan.
Well,
put it
Union
together.
Home Mortgage, get out there, talk to Mick Szoka. He's got the answers for you. He can certainly help you get your own home. So thank you, Mick. Great to have you on again.
Thank you. And
Yeah.
ask
Okay.
anyone to reach out to me. I'm in the
Well,
McCormick building.
Okay, and we have more information on Arizona Daily Mix.